Welcome, ladies and gentlemen. This is Quinn Millegan.
Drew Millegan also.
We are brothers, and this is the first ever Capital Call podcast. We're managers of the Woodworth Contrarian Fund here in McMinnville, Oregon, heart of wine country. And, what a day to start this. Like, what a fucking day.
It's been a long time since I've seen the circuit breakers almost trip like that. March of 2020, I think, was the last time we had a real trigger for those. It takes negative 7% on the S&P just to trigger the first level of those circuit breakers, by the way.
And mind you guys, today is April 4th, post-close, and everything was, all the indexes were down nearly 6%. I mean, off the tariff news and whatnot, geez. On the bright side, at least it motivated us to really have a conversation to talk about and wipe the dust off these mics that
that we've had sitting in our back office for forever.
Yeah, tell you how busy we've been.
Yeah, it's it is something. What I found most interesting about the market today in particular was, it looked like, if you look at the flows, it's definitely the institutions that have been largely doing the selling, which is unique. Normally you think of the institutions might be the ones doing the buying when the market goes down like this. But it was the retail investors that were buying back in while all the institutions were selling. But I found it most interesting that a lot of the names that really dropped in that first day or two of selling, they held up a lot better today. I mean, you take a look at Nike. Nike was down massively when those tariffs got announced, but it was actually up today slightly. It was the same thing with some of our value investments too. Just kind of goes to show that maybe they were oversold.
And it's an interesting market because you bring up some good points. At the same time, they were talking about the S&P, 16 down to every one company up. The Russell, 23 down to every one up.
It was a lot of red.
And you have, and by the way, we know about this institutional buying typically happens at the end of the day. And so there's usually volume at the beginning of the day, end of the day. Institutions buy in towards the end, and so oftentimes when the market gets hit, you'll see an uptick towards the end, and retail investors are the ones placing orders with tons of volume in the morning. And we saw tons of orders in the morning, but we closed at lows, meaning institutional investors are holding off. They're holding back. It's like they skipped some IPOs that were planned.
Well, heck, you talk to some of these institutional investors, and you're hearing chatter about calls where the institutions are all comparing this to 2008 to 1987, Black Monday. I mean, it's that rough with the policy that just got instituted. And it's really hard to find many redeeming qualities in this. I mean, it's just a sales tax on everything. There's nowhere to hide.
And, we're value investors. We invest in companies, not the market. We don't, we're not making any political bets or even wider economic bets, but, this was a hit that was indiscriminate. And we've had a sell-off since I think the peak was February 19th. So, Q1 was kind of rough. And it's just, the market hates uncertainty. And what we have not seen is certainty. But, we're value investors. There are a lot of good buying opportunities. You might not time the bottom, but there's a lot of attractive investments.
I mean, that's the thing. It reminds me again of March of 2020. I remember we had the worst month on fund record when those pandemic shutdowns went into place. You remember those shutdowns? Everybody shut down and locked themselves in their home for what was supposed to be 2 weeks, hoarding the toilet paper.
Well, yeah, the world ended.
Yeah, exactly. And we're all just, it's just post-apocalyptic now.
The figment of my imagination.
Figment of both of our imaginations. But what was wild about the post on that is that after that happened, after we had that worst fund month on record, we went on to have one of the best years of the entire fund. This is very different. This is not the same as the exogenous event that occurred that, caused the whole world to shut down, but it's pretty darn sudden and abrupt. I mean, it's kind of a black swan event here with this tariff.
I wouldn't say it's quite a black swan. I mean, you could argue that, and people are talking about recession and stagflation. And I mean, the underlying economy is doing quite well, and so this is literally just a result of policy. Throughout the day, you've got these positive events like Vietnam, who's a huge supplier for Lululemon. Nike is apparently negotiating for these massive tariffs, which were not reciprocal whatsoever. There was no rhyme or reason.
Didn't you just love how in the press release, in that giant table, they had the supposed tariffs on U.S. imports front and center to make sure that if anybody shared those charts, it was front and center that these countries were supposedly charging this massive amount on any trade with the U.S. when it just wasn't true.
Yeah, it was some very simple calculation based off trade deficit, and that's not even how trade works. But I digress, right? But there were some of these positive events where you think, okay, the cabinet's not going to negotiate, but then he says he is, and then you have the jobs numbers that came out, fantastic, then
the Fed didn't even cut rates,
right? And you had the market rally slightly when these events happened, but it just didn't quite cut it. And I think in large part that's because the institutions are again sitting on the sidelines.
Remind me again how much cash Berkshire Hathaway is sitting on right now. What is it, $300 billion?
Oh, a ton. And in fact, didn't you see on at the beginning of the month that Berkshire Hathaway bought Tesla for $1 trillion?
Yeah, exactly. It's all going to be McDonald's and Dairy Queen branded going forward.
And if you didn't know, that was in fact an April Fool's joke that fooled a lot of people.
Yeah, they had to put out a press release and everything. It was quite a. It got overshadowed, but it was quite entertaining.
Now, I will say this is a very interesting day and environment for us to start this podcast because it's literally called Capital Call, and there's a lot of investors, funds getting capital calls right now, margin calls. You saw a drop. I mean, what is it? The Nasdaq's like almost 20% off the highs.
Yeah, I mean, if you look at that weekly, it's just not doing you any favors. It only just barely didn't meet the qualifications for circuit breakers, and it's somehow almost worse.
And what's the circuit breaker?
The circuit breaker. Okay, so I can explain for those that may not know what a circuit breaker is. A circuit breaker is a market-wide shutdown in trading access. So NYSE, everybody just says halt. Nobody trade, nobody do anything. We're going to wait 15 minutes and start the market back up again. It's essentially a reboot. And there are 3 levels to the circuit breaker. There's a level 1, which triggers at 7% downsides, and it's based on the S&P. There's a 13% down level 2 circuit breaker, and then there's a negative 20% level 3 circuit breaker. Now, these circuit breakers can only trigger before 3:25 p.m. Eastern Standard Time. So if you get a drop that's substantial after that time period, the market will not shut off.
And we got close, but it did not happen today. I mean, it's not uncommon for it to happen, even if there's not a major event. Sometimes they just halt trading.
Sometimes just volatility can trigger it. That has happened in the past. And if you get a level 3 drop, that's really uncommon. But that will actually shut the market down totally, even after 3:25. I
think VIX closed up 50%.
Yeah,
which was crazy. It makes you want to invest in the VIX, but I'd rather just be invested in the stock market.
I mean, nobody was expecting the sheer magnitude of the tariffs that were imposed, and it was less than 24 hours notice. There's no way to plan for that, no way to hedge for that.
And I won't belabor the subject of tariffs too much, but so much for this Liberation Day. I mean,
liberate me from what? My wallet?
Yeah, what am I being liberated from? Maybe he meant it in the Buddhist sense, of being liberated from material possessions.
Yeah, we all need to be a little bit more zen in these times, right?
Yeah, maybe that's what we need.
Yeah, exactly. I mean, they say that when events like this happen, that one of the smartest things you can do is stand aside and not make any rash decisions.
Yeah. Now, at the same time, sometimes they're so far-reaching that there is nowhere to hide, right? And so you do have to make some decisions that are not necessarily what you'd like to make, but that might be some kind of reallocation. What I wouldn't, you wouldn't want to panic sell, that kind of thing. I mean, that's always a losing decision.
Well, not unless you're forced to. The reverse of a short squeeze,
Yeah. Things
go down so hard that you get a bunch of margin calls.
That's true. A capital
call, one might say.
And on that note, since this is the first one that we're doing here, might as well give you guys a bit of background on us. And this is my bro here, my actual brother.
Bruh.
Don't say that.
Why not? I like it.
Anyways, quick background. I mean, we kind of grew up in finance. He doesn't like this as much as I do, but I kind of say we've been in finance since we were in diapers, because we used to work for a family brokerage, and I mean, literally, our dad would show us smiley faces, frowny faces on the charts, and he was trained in the contrarian philosophy, and he trained us too.
Yeah.
I mean, you were what?
Yeah, he was in there playing the gorillas every morning for the market open.
Well, that too.
While I shredded in the back and stressed about girls in middle school.
Yeah,
but I did learn a few things. I did learn how to read charts at a very young age. I must have been one of the last people to be trained in that really old style of manual trading. Pre-algorithmic. It was just before that ended.
And you were licensed before you could drink?
Yeah, I was. That's usually how I like to describe it. There was probably a period of time where I was the youngest licensed broker in the state of Oregon.
Yeah, and speaking of, you never had a lick of alcohol before the legal drinking age, right?
Oh, yeah, no. It's amazing. I turned 21 and I stopped drinking.
And, I was also studying for the test. I was going to be Series 7 licensed, but we ended up starting the fund, actually, in late 2016. We've been doing this for 8+ years. And, we're... And
this is why I've seen a few market corrections in my time.
Yeah. And I went to Oregon State. Drew went to Linfield and Montana State.
I did.
And, we're stock pickers. Direct investors. We don't do derivatives. We don't do fund-to-funds. The real name of our fund is Woodworth Contrarian Stock and Bond Fund LP. It's just too long for most cases.
I still think it was way too long of a name, but, it's what we've got.
You live and learn. It would be more difficult to change it. But if, there might be a time where we might be invested in bonds. We're not currently. But we don't do, we don't get into futures or really any kind of options, because I'd rather just be invested in the market.
Yeah, the problem with commodities, I do like commodities. I like what they represent. They're very direct investments. They're very old kind of investments. I think some of the first really equity trading that we have a record of was agricultural futures trading that happened around the Mediterranean. I think it was in Greece or Anatolia or somewhere like that. But it's the fun thing about it, though, is that if you get into commodity trading, it's very easy to lose your butt in a half. And if you hold too long, you'll wind up, with a load of pigs in some Chicago feedlot, or, a rail car full of lumber somewhere down in Eugene, Oregon.
Good old Eugene.
Yeah, the dirty Huge. It's but there's that actually reminds me of a joke. You ever heard of an O'Hare spread?
Well, I have.
Well, yeah, but I'm asking. You could pretend not to know what it is.
Tell me.
All right. Well, an O'Hare spread is this thing.
Hopefully that's not an innuendo.
No, of course not. Stockbrokers are very, very clean, don't you know, Quinn? But an O'Hare spread, they actually use this in the show Black Monday. One of the writers had a father who was in the Chicago Mercantile Exchange, which is where a lot of the commodities are traded. Even today, they still have a pit and everything. And if you screwed up your trade so bad that most of your portfolio was gone, or like it was an irrecoverable loss, the O'Hare spread was you would throw what remained of your portfolio into a very, very risky trade, and you would also buy a one-way ticket to a country with no extradition treaty. And rather than sit in the office and wait to see if the trade pays off, you go to the O'Hare Airport bar and you watch the news. And if the trade doesn't pay off, you get on the plane and you disappear. That's the O'Hare spread. If it works out, you go back to work and you're a hero. But if it doesn't, you're gone.
Speaking of, and I hate to bring it up, but Black Monday, what a great show. Honestly,
what a fantastic show.
I mean, it's a little bit exaggerated, but they did a great job with that show. I especially love the stretched Lamborghini.
Yeah,
that I would like one of those myself one day.
I gotta say, it was very sad when They had, I forget if it was a person they had fall on top of it and break it in half.
They did, yes. I think somebody jumped out of the stock exchange. If I'm
what a heck of a trope. The stockbroker falling out of the exchange building.
Oh yeah.
I gotta say, there's hardly any actual events of that happening, but it gets used over and over again in shows and comics.
Has it actually happened historically?
There may have been some isolated cases. What it originates from is that in some of the early stock market crashes, there would be a sensationalized newspaper headline that says, like suicide's up or like broker jumps from building, and then that gets picked up. Whether it actually happened in any sort of meaningful number is another question. I've never seen any solid evidence in support of that, but
you guys let us know that are listening. Have you ever jumped out of the New York Stock Exchange and died?
Have you? What a heck of an insurance claim, man! Like, have you ever tried to claim life insurance from the afterlife? Let us know. Call in.
I'd like to know how to do that. Actually,
invest in the fund. I want to know what it's like in the great beyond. Is there an options market?
Do you have to be an accredited investor if you're a ghost?
Well, it's very cheap living to be dead.
That's true. Yeah. That's true. You're not spending much money.
No, you're not. So, anyways, it's we've had to revise a lot of our assumptions about stock market crashes. It's kind of wild to see the market react this intensely to a single action by a single individual. It's, we're used to thinking about stock market crashes being caused by like over leveraging and lax capital controls, unpredictable international crises. And then you just got this fucking guy. Like, what is going on with this?
Yeah, it's now I don't know if we could necessarily classify this as a crash. I would call it a correction. To some extent,
it has only been 2 days. I forget about that.
The market has been overvalued, and you're seeing a correction, and it's somewhat orderly, but it's just. We've even seen like pro-tariff pundits talk about how bad of an implementation this was, like unforeseen implementation, even if you're in favor of tariffs.
Well, again, less than 24 hours. I mean, technically they've been telegraphing this for like a month, but you didn't have the specifics settled on until less than 24 hours before the launch and the announcement of this. And then when you did get the announcement, it was so incredibly haphazard, and it was so incredibly massive compared to what people were expecting. I mean, these guys were imposing, 50% tariffs on Vietnam, or like 50% tariffs on Lesotho, 42% tariffs on the Falkland Islands. That's an island with a population of less than 4,000 people. I'm pretty sure there are more sheep on the Falkland Islands than there are people.
Don't forget the Heard McDonald Island, where there's maybe
Islands.
One researcher.
I saw a rumor that I believe is that the list matches up pretty 1-for-1 with the country level domain codes. What appears to have happened is they put maybe it was an intern. I don't know who they had do up this list, but it's just absolute. I'm not going to swear, but it's pretty haphazard. They looked up the country codes by top level like internet domains, so like the .ios, the .tk's, the .tv's, whatever it is. A lot of these territories have separate domain names, just so that the overlord country can benefit from like selling unique domain names. So you have uninhabited islands that are being tariffed 10% that have no trade at all. And the reason some countries like Lesotho got these wild 50% tariffs is because they're going off of trade deficits, which what a trade deficit is that all it is like, if I give you $10 and you give me, I don't know, like a wallet, like a handmade wallet out of leather that you happen to have on you, that would result in a $10 trade deficit between us. That's how a trade deficit is measured. It's just money in exchange for goods and services.
And I need to use that $10 to pay my rent, so I can't buy anything from you.
Yeah, exactly. Because it's well known Quinn is much poorer than me, so he has to spend all of his disposable income, all of his income on necessities.
Well, and materials to make those wallets.
And materials to make the wallets, of course. $2 on rent, $8 on leather. You're starving, you're dying, somebody help you budget.
The real question is, maybe this was a bubble, because why are you buying so many wallets? Why do you need them?
Why do I need? Because it's not worth my time to make them myself. I'm off making $10. I made $20 off of making fucking ice cream cones for my neighbor David or something, like for the same amount of work I can make $20 and then I spend $10 of that on wallets from you. This is how trade works. I mean,
now, I think it's pretty clear that it's haphazard and whether or not it was the fault of an intern that did it up, or they weren't even thinking about it that much, which is in and of itself concerning. But I would like to be wrong about the whole thing, and I'd really like to see some negotiation come out of this to put us in a good place. I have a hard time seeing it being worth it. I mean, we lost $6 trillion worth of value in these last 2 days in the market. And what was the announcement? The tariffs were going to generate $6 trillion in tax revenue?
Yeah, $600 billion, I believe.
Yeah, I think they announced this as $6 trillion. So what is that, over 10 years?
Look, any number they're coming out with this, it means there was another thing that I had pointed out where, if they are expecting these tariffs to generate yearly revenues, it means they are not planning on, taking them off. They're planning on keeping them on, and it is a question whether the market has fully realized that in their valuations, because that's tariffs are just sales taxes on U.S. businesses and consumers.
I have to imagine that I think the market could probably sustain a 10% all around the board tariff. I don't know if it's necessarily a good thing economically, but I feel like 10% across the board probably would be sustainable, but certainly not 97%.
There's another angle to be had here, where one of the things that the president may be trying to do is he's trying to replace other sources of revenue. So there's been a big push in the Congress right now to maybe just outright get rid of the income tax, which, if you're looking for another source of revenue and you don't want to do any wealth taxes, you don't want to do any domestic sales taxes or value-added taxes, people look at tariffs and they're like, look, we could just charge other countries for this. It does change behavior, and it causes some pretty direct inefficiencies in the market. And, some people are going to argue like, we'll just make more stuff here. But, it also ignores the fact that, I may be terrible at making wallets,
I'm the best wallet maker out here, apparently.
Exactly. If I can't buy them from Quinn, then I have to make them myself. And then, I'm spending all my time making wallets instead of making that are worth $10 to me, than spending all my time making ice cream cones that are worth $20 to me.
You know what, though? I did actually make a wallet out of a circuit board when I was a kid. Yeah, it was a Father's Day gift. I saw it on like a how-to thing online, so I made it out of a circuit board I had.
Did it work?
I did. Yeah.
No, I mean, like, could you turn it on?
Oh, no. This required a flexible type of circuit board, and I cut it up. It was not used.
I think I remember that wallet. Yeah. It was see-through, so you could see exactly how much money was in the wallet when somebody went to rob you.
I mean, when you put it that way.
I'm sure Dad loved it. I'm sure he used it at least once.
Oh yeah.
It's an interesting market. World.
I mean, bottom line though, blood on the streets. I mean, everything red on Thursday, everything red Friday, and that's off the heels of a sell-off that began in February. And the consumer non-durables were somewhat positive on Thursday, not on Friday. There's nowhere to hide. And so that's it's difficult. I wouldn't want to be necessarily like, some managers' reaction is to go all cash in this kind of environment. I do think that's a mistake. Because there's a great interview of a trader, I forget his name, that they did yesterday, not too long ago, about just the emotion on the New York Stock Exchange. A trader that's been there a long time, and it reminded him of just the sentiment of the onset of COVID, when we had that massive dip, where it's like you didn't see this coming, Although maybe we should have seen this coming.
I do distinctly remember talking to my friends about being concerned about COVID during the Super Bowl party we had back in February. And mostly people would look at me like I got three heads because it's like, it's some random disease in some foreign country that happens like every year. So now, to their credit, I didn't do anything about it. All I did was talk.
Yeah, but you know what? March of 2020 was one of our worst months on record at the fund. Next month, one of the best months on record, because ultimately we're in an environment where, it is kind of I guess somewhat of a similar situation where, the economy is doing well underlying, and you have this weird external factor. In this case, it's policy. But the sentiment that the trader had on it's just like, you're ripping your hair out. You're bleeding and it's painful, and you just gotta be in pain.
I would say for your average retail investor or someone with a 401k, just don't look at it. It's not going to do you any good. There's not a very good chance you're going to be able to time any of this. And especially if you're just in a broad index fund or something like that, and you're young, and by young I mean under 40, or heck, even under like 45, just don't look at your 401k right now. It's not going to be worth it. You're going to give yourself a bunch of grief for no reason, and leave it to the professionals to try and work around this volatility.
Speaking of volatility, we've got a great position in Kohl's. And
good old Kohl's, the the suburban mom retailer.
You love it, you hate it. We put out a tiny little piece in our Millegan memo, which comes out every month. You guys should subscribe. Put your email in our website. I'll plug that. And yes, we are sponsoring ourselves, so that was a paid sponsorship.
Still not sponsored.
And it did terrible when the tariffs were announced. And today it was up 8%. It was green in a sea of red. And you know what? It bounced off a level. I mean, the sheer liquidation. I think liquidation value for Kohl's is somewhere in the tens.
Yeah,
book value of the company is 34. They've got $8 billion in real estate, and the company was trading down in only like 1.1 in long-term real debt. The lease obligations are misunderstood. I mean,
I remember when they made that accounting change back in the day. There was an actual change they made where they started counting long-term lease obligations as debt, basically. And there's a lot of sense to that. There's a reason they did it. But fundamentally, leases are not the same as long-term debt or even really short-term debt, because one of the things you can do with a lease, if times get tough, you can renegotiate them. Not as strong of a positioning with debt when that happens. So you can't really treat leases exactly the same as debt, which is why we usually kind of take them out when we try to figure out the exact balance sheet of a company.
But and Drew, to your point, I mean, when you look at the balance sheet of this company, they've just ignoring the actual underlying real estate equity, just looking at the equity in the company is like, what is it, like $4 billion or something?
They're sub $1 billion market cap right now.
Right. I mean, they could literally take out a 30-year mortgage on their real estate and take themselves private.
It's to the point where they could essentially, with the savings they had from cutting their dividend. Another reason why Kohl's is probably down, by the way. They cut their dividend. Pretty much expected. It's what I would have done.
They still have a dividend, by the way, which at this level is like
wild.
Almost 8% now.
It's, when they cut the dividend, the amount of savings from the dividend alone, they could almost take themselves private. Actually, I think just counting the amount of actual float out there, not the market capitalization, they probably could literally take themselves private off of just the savings from the dividend.
I think it was like they could buy half the float. In fact, the quote from someone on StockTwits was they could literally buy half the fucking float with the money they saved on the dividend.
You hear that? Sponsor us, StockTwits. That's a call out.
I really wish.
The bottom line with Kohl's is that the company, there's like, even if they had multiple years of negative earnings here, they have enough flexibility with their real tangible asset portfolio of real estate and other assets, and I don't think necessarily they're going to go into multiple years of negative earnings, they would probably be able to figure out some sort of financing arrangement. I mean, it's just absolutely unsupported to have it trading where it is. The street thinks it's gone bankrupt, and
it's expecting profitability this year. It would literally cost them more money to go through bankruptcy than to take themselves private.
I will say that profitability, you go into a recession, you're talking like a 20% reduction in margins for retailers.
Sure, but you have to understand, almost all of their stores are currently profitable, and I understand, if you go into a recession, they are impacted. However, there's some other factors. Kohl's is kind of like this mid-tier value that you might even see some trickle down from like a Macy's or a Nordstrom customer that's trying to save a few bucks.
God, I love it when
Kohl's cash.
Kohl's cash.
And now that the company is going to reduce exceptions to their Kohl's cash, but you've also got another political headwind. They got rid of the de minimis exception for items under $800.
Yep.
And so there's no reason for you to buy something for less than $800 on Alibaba or Shein or whatever, if it's just at Kohl's, and they don't have to.
They bought in bulk.
Right.
They got around the de minimis exception. What's wild about that is that China did impose retaliatory tariffs. Announced today, it's what killed the TikTok deal, or at least has so far killed the TikTok deal. Allegedly on a lot of these things. It evolves hour by hour, minute by minute. But Kohl's has this pretty massive advantage in that they can continue to sell a lot of these sorts of products without having to deal with that de minimis there. So in a way, they do actually have less competition as a result of these tariffs, even if their supply chains have been pretty fundamentally disrupted. Now, just to take the devil's advocate position here, Quinn.
You're saying you're the devil?
I am saying the devil.
No, you're his advocate. You're his attorney.
I'm his attorney.
Okay.
Yeah, exactly. It makes it a little bit better.
Right.
Kohl's did recently spend a long time drawing down their inventories. They did a sort of inventory repositioning wherein they're holding a lot less in short-term goods on hand while they were going through a bit of a transition with some of their brands. So there is an argument to be made here that they're in a little bit of a worse position just vis-a-vis their inventories compared to some retailers because they've got less of a cushion to kind of draw down on. However, do you have any counterpoint to that?
I mean, I'm pretty much in agreement.
Yeah, I mean, I'm trying to generate some controversy for the discussion, for the back and forth. But yeah, no, I mean, I know we're pretty much in agreement here.
Yeah, I mean, there is that risk, but I would contend, the company has so much in assets that they have the ability to fuck up and pivot.
Yep.
And they can do that multiple times. I mean,
yep.
They literally have enough. I mean, they had, and this is before the recent price drop. After earnings, they have enough in inventory that they could liquidate it all in a clearance sale and take themselves private.
Yep. It's kind of ridiculous.
I mean, and then they could just cease operations and sell the real estate.
Kohl's is quite frankly our favorite kind of company right now. They could fall over and almost die and still probably be valued more than they are trading at right now. Back in, I believe it was in the 80s, you had this power plant in Chernobyl, Ukraine, what was then Soviet Ukraine, which blew up. Famously, there was an HBO documentary about it, dramatized, of course. And it was terrible. It was one of the worst, if not the worst, nuclear disaster in human history. Way worse than Fukushima in a lot of ways. And there's still an exclusion zone today. But at the time, there was also another nuclear power plant that was owned by, I believe, Public Services of Colorado, which they were concerned would also go nuclear, would go meltdown, another 3 Mile Island. And
one might say nuclear.
Yeah, it would go nuclear. Nuclear?
Speaking of Bush, they should really They should really start.
Speaking of Bush, is anybody going to get that reference?
He famously kept saying nuclear instead of nuclear.
I'm going to continue to say nuclear just because it pisses some people off.
Yeah, but speaking of Bush, I think they really ought to start throwing shoes at politicians again.
You know what? I do miss that. But
And I'm talking every politician.
Yeah. If I can get back to the story.
Oh, yeah.
So they were worried this power plant was going to blow up. And so the question became, okay, so what if it does blow up? Well, you're screwed well, we got bigger problems to worry about if it blows up. But what if it doesn't blow up and they just shut it down?
Right. And this is much larger than Chernobyl.
Much larger. And the answer was, after doing a breakdown of the actual underlying assets of the power plant, what happens if you sell it for scrap, it was actually worth a lot more to the company than in terms of scrap value than the company was trading at. Which meant it was a strong buy. That trade that we were trained on, the clients doubled their money as a result of that trade.
And this is a classic contrarian value play. I mean, it's like you look at Buffett's early days, and one of the famous trades he made a lot of money on was Amex. Amex was American Express was basically scammed by this salad dressing. Basically, they had a lending department, and it was a salad dressing scandal of whatever it was called. And they had loaned against all this inventory of salad dressing that was in barrels. And what they did is, because there was oil in salad dressing, they would fill a barrel full of water, and then they put a little salad dressing on top, and it would all float to the top and stay on there. And so when they came to inspect it, they thought there was all this salad dressing, when in reality it was mostly water. And so when it turned out the
salad dressing bandits.
Right. But they were overexposed, and American Express kind of took a massive hit. But this is an investment that Warren Buffett looked at. He said, okay, that's an opportunity. He made a lot of money on that Amex trade. I don't know what it was, but
yeah, well, I'm pretty sure that was one of the trades that made Warren Buffett.
Yeah.
But it's trades like that. Companies where all they have to do is not die for them to make money, really. Or even if they do die, the stockholders still make money after the bondholders.
I'd really like to be in that position where all I have to do to make money is not die. Then even if I do die, that the people around me can still make money off of me.
Well, that's what life insurance is for. It's a bet on when you're going to die between you and the insurance company.
And, a company like Kohl's.
All they have to do is not die.
Just a guy with wads of cash falling out of his pants. I mean, he could literally die, and the investors are still going to have that wad of cash.
Yeah. It's there's a lot of valuations like that in the market right now, and a lot of people are really concentrated in those really big names, and that's where all the losses has been concentrated. Names like Google, Amazon. Amazon has had 8 straight weeks of negative performance.
I believe it was 9.
Was it 9?
Broke the record since 2008. For Amazon at least.
Oh, that's so bad.
But hear me out. There's light at the end of the tunnel. This is really a direct result of policy. That this first of all, it was the uncertainty of the policy, and then you actually got the policy,
and it was worse.
And also still somehow uncertain.
Yeah.
So I mean, and the market. Ladies and gentlemen, the market. There's this great book called Stock Market Blueprints. It's a little bit dated. I think the last edition was 1987. The first edition was the 60s.
Feels like it was written in the 1950s.
Oh yeah, you can tell. It's a little dated. Don't hold it against me. By Edward Jensen. But what he does do is explain the stock market, and the price of a stock is not what the company is worth. It has zero relevance to what the company is worth. It is simply the difference between buyers and sellers. Buyers and sellers are people. Now they might be bots. Either way, driven by human emotion.
Yeah, and it's the price is just where irrational moves. It was where two irrational actors settle on for the value of what they will exchange their shares for. And people buy and sell for all sorts of reasons. Say if an investor wants to buy a boat, they might just sell out some of their stock for it. There's no real rhyme or reason to it. It's just like maybe there's a lack of buyers. Maybe there's too many buyers. Maybe there's not enough sellers. Maybe there's not enough of either.
Come to think of it, the only reason I ever sell out at inconvenient times is to buy boats.
Yeah, it's those darn. Every man has this thought at some point in their life. They're sitting in the kitchen and they just think, I should buy a boat.
It's not going to fit in the Yamhill River, though.
No, it's not.
Basically like one giant rolling turd.
Yeah. Well, everybody always regrets buying a boat. Those things do nothing but go down in value. They're worse than cars. So,
speaking of cars, during COVID, cannot believe what we did with our cars. And I don't think what a weird environment where used cars go up in value. I don't think that's happening right now. But when COVID came on, we had these used cars, and suddenly they were worth more than what we paid for them, even though we put mileage on them. One of them even had basically bad history on the title. Sold the cars. Couldn't buy used because it's all overinflated. So we buy new because they're less inflated prices. And then somehow those new cars went up in value. Sold them. Then the new cars that we bought then went up in value, and we got EV tax credits. Sold those. We're like, this cannot last, right? I mean,
I remember you had a hell of a time convincing me to buy those cars new. I hate buying new cars.
But the thing is, the used cars were sometimes more money than the new cars.
Right.
Which was stupid. Why would I buy a used car for more than I could just buy one new? That was ridiculous.
Well, not only that, we bought into electrics,
yeah.
which we figured were going to retain their value more because at the time there was a shortage.
And we sold them before they started decreasing in value.
Yeah.
Which is why we were thinking, this can't last. And so we ended up buying depreciated luxury cars that nobody else was stupid enough to buy.
Well, hey, speak for yourself. I like my Porsche Cayenne.
Oh, don't get me wrong. I love my car. And we don't drive that much, so, maintenance isn't really that big of a deal. But the reason we looked into those, and this is the reason we tell ourselves, even though because of course we like the cars.
Look, in today's world, unless you're living in New York City, you're going to have a car. So you kind of just have to factor that cost into your budget, at least in the U.S.
Oh, sure, but depreciated luxury just didn't inflate as much, and they're so far from the original MSRP, and they will never get back there.
Oh yeah,
that they were apt to be less affected when eventually the car market did correct.
Right.
So
what we did is we took large magnitude small magnitude gains in more expensive cars, and converted those gains into smaller absolute costs of buying depreciated cars, where, if you have a $60,000 car that goes up 10% in value, that's $6,000. If you have a $10,000 car that goes up 10% in value, that's $600. So, you buy a few high-priced cars and get a big upswing in their value, you could basically convert that into a very nice 90% depreciated car.
And that's a value investor for you.
That's a value investor
even in our lives. I even made money on a car I didn't even own. I pre-ordered, if you remember, I ordered a Rivian, and by the time it was going to get delivered, I didn't want it anymore. I already had another car.
I remember meeting that guy, yeah.
Yeah, he was a really nice guy, actually. But Rivian was not really keen on you selling the pre-order, and so I had to add him to the title, and technically we both owned the car when it was purchased, but he actually bought it for a premium over, because I was getting an old price, lower than what he could buy it new.
Yeah, I remember you arguing to keep that price on the phone because you literally bought your place in line hours before they raised the price.
Literally hours. Like I bought my place in line thinking, I might do a refund, and then 6 hours later they raised the price, and I'm like, okay, I have to buy the car now. It's just free money sitting there.
Yeah, exactly.
And I didn't even have to buy it. I got him to buy it with me, and then basically turn the title over in a transaction there, and I got to make money on a car I didn't even own.
How many times have we basically been forced to make money on something that we didn't know was going to happen? I mean, I can't tell you how many times we've been like, oh no, they mispriced this. I guess I have to buy it now. I'll just resell it. Like, true trader mindset with you, I got to say.
Don't you just hate being forced to make money?
Yeah, don't you just hate making money? Yeah, I sure would like a liberation from my profits one of these days. A big liberation day. One might say.
That's a good idea. They should make that a whole thing.
Yeah, have a celebration and everything.
So we know you viewers. You've got limited time, so we want to transition to another subject. And I was arguing with Drew over the interestingness of said topic.
The interestingness of interest, is that what you're
Oh,
about
that's
to
true.
say?
I didn't even pun intended.
I have much
Unintended.
interest in interest. Life
Yeah.
is in the margins.
But the what was that interview with Powell?
Well, Powell got on this morning and he gave an interview at some
Jerome Powell.
it was a club. Jerome Powell, yes, the chairman of the Federal Reserve, the man with a plan himself.
Oh yeah.
And what people were expecting from the Federal Reserve here was that they were going to do a rate cut. Market was pricing it in. They're continuing to price in rate cuts over the course of the year. They're effectively expecting a recession. The Federal Reserve cuts rates to achieve two goals. It tries to keep unemployment stable and low, and it tries to keep interest rates and inflation stable at their target. The target's totally arbitrary. It was invented by some newscaster in, I think, New Zealand. The 2% target is totally made up. The stability is arguably more important. And, the idea that people will accept 2% inflation is also the other goal. But
don't forget his third directive. The Grateful Dead.
What?
The Grateful Dead.
Yeah, that was the other thing we learned about on his conference today, is that they ended it in apparently Jerome Powell admitted to having followed the Grateful Dead in the 60s and 70s. Is he that old? Was it the 60s? It can't have been the 60s. That would make him, what, like 100 years old?
Oh, what? The 60s? You could be a kid in the 60s and not be 100 years old. I mean,
Yeah,
geez.
that's fair.
Although he would have to be.
He'd have to be in his 70s, which...
Yeah, which I think he is.
Yeah, okay, so it makes sense.
Chad,
in his
how
wild
old is
teenage
Jerome?
years, he apparently followed the Grateful Dead around. So he doesn't have the newer stuff that was recorded on, like, 8-track tapes by some of the tapers in the audience.
I'm hearing this for the very first time. Jerome is, in fact, 72 years old.
Jerome Powell is 72 years old. What a man.
I wish I could do a better Trump impression. I feel like that'd be valuable.
Yeah, basically just, I can't do it. It's just going to sound disrespectful if I do it. And not in a fun way. It's going to sound like I'm throwing up into the mic.
Yeah. It's too bad Powell doesn't have a very recognizable voice. We could impersonate him too.
I really have no opinions about anything, and I don't think it's good to comment on anything that elected officials do. I am purely reactive.
Jerome, is that you?
He's kind of deadpan, but he's also kind of got like no distinguishing features about him, in terms of how he speaks. I actually really like Jerome Powell. Yeah, I feel like he's very level-headed.
He seems. I mean, he was going to pull off the soft landing until basically this event happened.
Yeah, that was wild. It's, I know it's gonna be a divisive opinion talking about how well the economy was doing in 2024, but it really is not an exaggeration to say that the U.S. was doing better than every single other country during that administration, and with Jerome Powell, they really pulled off what was essentially an economic miracle. Bringing inflation back down, and then keeping unemployment as low as it was. But as we found out, people are more sensitive to inflation than they are to unemployment, I believe. But I found it very interesting. During those years, especially in the months leading up to the election, there was a really big divergence in the polls when you ask people what their opinion of the economy was based on their political proclivities. So if you were conservative going into the election, you thought the economy was terrible. You thought it was bad. You thought Biden was wrecking the country. And then if you were liberal, you wound up thinking the economy was doing pretty good. The data, by the way, did show that the economy was relatively stable. Besides some inflation, the economy was doing much, much better than the rest of the world. And the inflation was a global phenomenon. So, and, cue up the Trump administration here with its immediate announcement of tariffs. The economy has continued to be very, very resilient. And unemployment is still near record lows. And inflation has come down a lot. But it really has kind of hit everybody like a ton of bricks how potentially damaging these tariffs are, especially now that once we start to see what other countries do in response to these tariffs. Because,
well, kind of on that note, I think the street too so many investors are obsessed with lowering interest rates.
Oh God, I wish they would stop.
And interest rates are actually still quite low. Now granted, I actually think it may have served the Fed well to have lowered rates today, or expected to lower rates, because that would have been a great signal to the market.
It would have tempered the market a lot.
It would have tempered the market. It actually was well timed. Fortunately or unfortunately, they didn't do it. They're in a wait and see. But overall, interest rates are low, and I think we have become addicted to these low interest rates for 20 years.
I had it described to myself this way on interest rates. The direction we've gone with interest rates since really the Volcker years has had a ratchet effect. And what do I mean by ratchet effect? You ever have one of those ratchets in your garage where you can turn it one way but not the other, and it goes shink, shink, shink?
You mean a ratchet?
Yeah, ratchet. Yeah, I mean a ratchet. That's essentially what we've done with interest rates. We pushed it down, and it has been always advantageous to push it further and further and further down, and the financial sector has gotten more and more efficient, and they've been able to tolerate lower and lower rates and lower spreads. But what happens when you get to zero? You run out of runway, so to speak. And unless you're Japan with negative interest rates are a thing. It's very, very difficult to respond in a sort of traditional reaction stabilization manner to the economy when you don't have any room to drop any further. So I understand why they're hesitant to drop interest rates any further.
Right, and it just really would have been well timed. But yeah, rates are low. So what are you gonna do?
I will say the U.S. economy is unique. People forget about this, but especially when it comes to mortgages, we're unique in that we offer 30-year fixed mortgages, and that's a direct subsidy to homeowners that the government guarantees. Essentially, the government created that market for long-term fixed interest rates. Before they did that, it was you're talking like 20 years, 10-year mortgages. They may be variable rate. You go anywhere in Europe, you're going to get variable rate mortgages, or even Canada. Interest rates go up over there, and everybody's home costs go up, and it makes a sort of sense to keep those shelter costs more stable, but it's effectively a kind of rent control for homeowners. And it does lock people in. The reason I bring it up is it kind of locks people into their houses when interest rates go up. You got a lot of people out there in homes where they got like 2.6, 2.7% rates.
Right.
And, what are they going to do? Buy a house at like 5-6% for double the cost?
I wouldn't.
Yeah, I'd stay exactly where I am.
Right.
It's gotten to the point where, like, a lot of these people are, even if they do move out of their houses, they don't actually sell it. They just rent it out to somebody for a below market rate. It's got to the point where in a lot of markets, it's actually, you can argue in the long term it's always better to buy, but there are a lot of housing markets out there right now where it is just cheaper to rent, even when looking out like a year. So, it's locked.
You might be paying less in rent than you would be paying on interest in a mortgage.
Right.
Now you get the asset and it's appreciating, and there's a bunch of other factors to it.
Especially if you're talking about buying a house with land under it and not like a condo or something like that. My point here is that the U.S. market is unique in that there's a lot of distortion when you're talking about the kind of interactions that your average consumer has with the interest rate environment.
Now, Drew, I think the next financial innovation that would really, really help the U.S. consumer is a 30-year fixed mortgage on my Crunchwrap Supreme.
Buy now, pay later.
I'm telling you, the price of the Crunchwrap
DoorDash.
Yeah,
get a loan on that burrito.
The Crunchwrap Supremes, they've gone up in price. I have been tracking it by buying them constantly.
I would gladly pay you Tuesday for a hamburger today. I wonder if anybody gets that reference. I barely get that reference. That's
you guys let us know.
Yeah, there's just a lot of debt. People have been talking about investing in credit card companies, and you're starting to see delinquencies go up a little bit here. There's a lot of recession indicators that are happening right now, which is why people are kind of freaking out over these tariffs.
But, I think you have other factors of a very strong underlying economy to where even if we do have a recession, we're going to be very well off afterwards.
This is where you get into that argument, like, is this short-term pain worth the long-term realignment? And my question is, what does that realignment look like after the fact? And also, like, what do you mean we're going to be stronger as a result of this? Are you saying that we're going to have, like, in 3 years, we're going to be making all our washing machines here in the U.S.?
Oh, no. Let me be clear. I'm not advocating for this, like, reshoring or whatever. I don't think, the whole idea of bringing manufacturing back to the U.S. is kind of a flawed discussion. What I'm saying is, and I'm not advocating for a recession either, but if we do go through a recession, I just think it will be muted, because we're just positioned so well. We're like Kohls. We can fuck up. What, you don't think so?
I don't believe in positions so strong that, well, you've got me second guessing myself, because I do believe that with companies. Companies, when they have enough assets, can come back from pretty much anything.
And I'm not saying it's a good thing. I would rather it not happen, but I just think that we will be okay.
Yeah, I am interested to see if they are able to successfully bring down the deficit with these tariffs. I do kind of fundamentally disagree with the idea that a tariff is a more efficient tax than an income tax. I know a lot of people really hate the income tax. I think it's kind of not deserved in a lot of senses, although it is deserved in some other senses. The nice thing about a tariff or a sales tax is that it's not something your average consumer is going to actually interface with on a daily basis, or have to think about when it comes to, like, money they earned. It's something that comes out at the point of transaction, not at the point of, you file once a year and you discover, oh no, I underpaid by $5,000.
It's like a gas tax.
A loan. It's like a gas tax. The thing about taxes is it's not just about economic efficiency; it's about the stability of the tax. And there is a point to be made that with a tariff or a sales tax, that is a consistent revenue stream for the government that comes out consistently and generates revenues that you don't necessarily get a lot of pushback on, even if they damage the economy in some pretty fundamental ways. So there's some push and pull with that.
So, I really hope we come out of this, basically public negotiation positively. It's just there's a lot of short-term pain. $6 trillion in value. I
do want to emphasize, though, with that $6 trillion, that is a blanket sell-off. There are deals out there for the people that want to find them. Yeah. In the time of ETFs and mutual funds and broad-based market Vanguard, whatchamacallit funds, they're just selling everything, good and the bad. So if you go out there and you really look for it, there's some very solid deals right now. Yeah. And even some short squeezes if you're so inclined. I know people love a good short squeeze.
Oh, yeah.
I know I love getting my shorts squeezed.
Well, on that a blundering disappointment, what do they say in Top Gear?
Maybe cut that joke out. I don't think that one's ready for prime time. I don't want that one. It's floating around there.
Well, you're in luck because it just may be. Might make the cut. We'll see. On that note, this has been the Capital Call. I'm Quinn Millegan.
I'm Drew Millegan.
And we're both brothers, allegedly, and business partners, co-managers of the Woodworth Contrarian Fund, and publishers of the Millegan Memo. You can go to our website, www.woodworth.fund /news.
Gotta love that .fund domain.
Oh, yeah. It's .fund/news. You'll see a section where you can see all of our Millegan Memos and how to subscribe. And, let us know what you think, what you'd like us to touch base on. We figured we're always talking shit in the office anyways. Might as well let you guys hear it.
Thank you.